the next 30 minutes, please start the recording, Kim. And it is recorded. So for Matt and Nick, we're recording the actual panel, but the Q&A at the end will not be recorded. So just to be aware of that. So the first question really is, now that you've introduced yourself, is about investment themes. I think it's quite confusing to a lot of people who are new to the space. And in our audience, there are LPs in our funds, but there are also people who maybe have made very few forays into the space. So it's quite confusing. So how do you break apart blockchain, and how do you think about the investment themes that are underneath the title of blockchain?
Yeah, it's something we've thought long and hard about for a long time. I remember when we were putting together the initial slide that would be the investment strategy for the fund that we managed at Fidelity, we had three buckets, as any traditional management consultant would. And basically, we said there's three distinct trends here that are happening at hyperscale within the blockchain space. The first is the monetary use case for blockchains. So the idea that something like Bitcoin, something like Ethereum, represents a non-sovereign value storage mechanism. And there's a lot of excitement around that. There are entire businesses that can be built just to support that use case. The second theme was around financial services. And so back to my earlier comment around frictionless capital markets and the ability to move assets peer-to-peer without trusted third parties, there's going to be a lot of innovation there. I would point to stable coins as a killer use case within that financial services bucket. And then the third bucket, we always thought of it as decentralized internet architecture. Sometimes people call that Web3 now, but the idea that software itself could be community owned as opposed to running centralized software. And when we set out to start the fund, we really looked at those three themes and said, look, we believe in all of them. They're certainly happening over different time horizons. Bitcoin is the first thing that's happening and the infrastructure to support that. But we've really tried to focus on investments in companies that benefit from all three of those massive trends. Pass it over to Nick to maybe go into a little bit more specifics on some of the recent themes that we're looking at underneath those three buckets.
Thank you.
Yeah, so, one thing I think I maybe regret at the genesis of Castle Island was being too thematically focused. And that's something we've evolved over the years, is I think we've actually become less driven by themes. All that said, at the moment, we do have some major themes that characterize our investing. So the first one would be stable coins. So of course, just tokenized dollars that are circulating on blockchains. And that seems to be the primary killer app of blockchains, just in terms of the number of people worldwide that are using them, the generation of value globally, even outside of crypto use cases. We see stable coins being adopted in many emerging markets as a digital dollar alternative. So that's driving a lot of investment activity at the moment. Within the stablecoin bucket, we are investing in stablecoin issuers. So issuers of new stablecoins, they monetize on a net interest margin basis. And also fintechs, basically mobile money apps, e-money apps, things that look like conventional fintechs that are facilitating any number of different types of transactions, remittances, exposure to digital dollars, yield, etc. It's just with the back end being powered by stable coins. And the particular wedge market that we see doing very well there is Latin America. And so we're seeing significant disruption, in particular to the remittance market via stable coins, which are just fundamentally cheaper than correspondent banks. The other sector we've focused a lot on this year is new layer 2 networks built on top of Bitcoin. So Bitcoin is kind of an outlier within the crypto space in that it's by far the largest crypto asset, but it doesn't have much in terms of second layers built on it. Historically, that's just been Lightning, the Lightning Network. Ethereum, by contrast, has a significant amount of Ether locked up in these L2 networks that allow for more flexibility in transactions. So Bitcoin is kind of playing catch up now. And there were some key technological and cultural developments that allowed for the creation of L2s on Bitcoin, really just in the last 6 months or so. And so now we're investors in 4 different Bitcoin L2s, and we believe that if Bitcoin reaches parity with Ethereum in terms of having this vibrant ecosystem of layer 2 networks that allow for more scalability, then we'll see some really outsized outcomes in that category. One thing also to mention is there are places where we're just not active because we don't feel that we have a comparative advantage in those sectors. And so I'd say crypto gaming, we're not particularly active in, and metaverse, we haven't been active in. Not to denigrate those themes or the funds that pursue them, it's just that we know what we're good at, we know what we know. And so, we have a bit of a narrower focus when it comes to those sectors.
Fantastic. Thank you. That was very thorough. But I want to double click on those two topics, stable coins and layer twos. But before we go there, just quickly, are there any geography or stage focus to Castle Island just that you want to share?
Sure. Yeah, we do pre-seed, seed, and Series A. That's the strike zone for us. Geography, I'd say we've historically done a lot in the United States, but lately with the adoption of stablecoins, we find ourselves going outside the United States quite a bit. So Latin America has been a very hot market for us. We've done two deals in the last quarter in Latin America. I believe we're in Yellow Card together in Africa, which is another company that is performing exceptionally well on the back of stablecoins. So we really see this as a global trend. Expect that we'll be doing a lot more international investing on the legs of this stablecoin thesis in the years to come.
Yes. Thank you. I just wanted to make sure the audience got that part of the equation as well. Yes, we had the CEOs of Yellow Card, Uphold, and Archax this morning. And then we have the CEOs of Securitize and senior executives from Coinbase and Bitwise this afternoon.
Awesome.
So if you can stay around for those, you'll find them interesting. But so going back to the two investment themes, let me just start off with the second one. And Nick, I'm sorry if this sounds incredibly basic, but some of the people here may not really know what an L2 is. I think we all know there used to be operating systems, middleware, and applications. But in the blockchain space, how do you think about it? What is a layer 2 and why do you need one?
Yeah, great question. So it's easiest to reason about this with analogy to traditional payment systems. So when you want to move a lot of money with final settlement instantly, you'd use a bank wire or maybe ACH. But if you wanted to move a smaller amount of money, maybe with deferred settlement, in a faster, transactional manner, you might use a credit network, like Visa, for instance. You might use cash, you might use a check. And so payment systems are inherently layered. You don't have all transaction types on the same layer because transactors have different needs in terms of settlement finality, how certain you are that the payment has settled, and settlement time, and just the means of payment. And so payments are very multidimensional. And so what happened in the payments landscape is you just have dozens and dozens of different ways to, make a transaction. And it's the same with blockchains. We're not going to have just a single network that facilitates transactions because transactors have different needs in terms of finality, speed, recourse, etc. And so Bitcoin at the base layer, I would analogize to Fedwire, so the network that processes wires. Bitcoin transactions tend to be large. They're a little bit cumbersome. The Bitcoin network only processes approximately 7 transactions per second. It's kind of the maximum. And of course, they take some time to settle, an hour or so. But that's faster than, for instance, a credit card payment, which might take 120 days to finally settle. And so over the course of history, and it's been 15 years now, the last 5 years or so in Bitcoin have been focused on developing this layer 2 network called the Lightning Network, which would enable smaller, faster payments on Bitcoin, where not all of the data from the payment is, inserted at the base layer, but you have a deferred settlement. And that's how really all payment systems scale, is deferring settlement until later. You also get other good qualities like recourse when you do that. And so, over time, we developed these architectures for L2s on Ethereum, the most popular ones are rollups, which is another form of deferred settlement where you have transactional information that's periodically batched, aggregated, and compressed and posted to the Ethereum blockchain. And it seems to be the best approach. What's exciting right now in Bitcoin is it seems to be the case that it's possible to build a rollup, specifically an optimistic rollup on Bitcoin. So taking the state-of-the-art technology that we have on Ethereum and doing it on Bitcoin, which opens up a huge new transactional space. It would allow for smart contracts that are compatible with Ethereum, with the Ethereum virtual machine. It would allow for a significantly larger quantity of transactions, faster transactions, more complex. And so that's the kind of thing that excites us as sort of a key fundamental technological development, moving beyond the very limited transactional space of Bitcoin, and bring it to parity technologically with sort of where other blockchains are today.
Got it. So, so for the, as investors, you're investing in layer twos. And then the question, I guess, is what are the big problems those investments are going to solve? So what are some of the end user applications that the people on the phone and around the world might actually see new products and services being built against?
Yeah, I mean, for Bitcoin, a layer 2 network would allow for just fundamentally more capacity. As I said, Bitcoin covers about 7 transactions a second, about 500,000 transactions a day. That's clearly not enough if you want to scale the blockchain to a global audience. So the first thing would be scaling. The second thing is more transactional richness. So allowing the creation of actual smart contracts, decentralized finance on Bitcoin. So that would allow things like lending, for instance, in a non-custodial manner. So you're just able to build this whole suite of products which already exist, for instance, for Ethereum. You'd be able to build them with Bitcoin collateral natively in a trust minimized way. And we've already seen that there's, significant demand for those kinds of products. And then the other thing would be asset issuance on top of Bitcoin. So initially, stablecoins emerged with Bitcoin on kind of a primitive asset issuance protocol. Then stablecoins went to other blockchains like Ethereum and Tron and Solana. Building a layer 2 network on top of Bitcoin would allow the reinsertion of stablecoins into Bitcoin so you could settle dollar-based transactions on Bitcoin with stablecoins and any other arbitrary asset type, whether it's tokenized fixed income instruments, tokenized securities, real estate, etc. So it just vastly opens up the scope of the kinds of transactions you can make with Bitcoin. And we've seen this be very successful in other blockchain contexts. And we're pretty excited about, what the next 6 months look like for Bitcoin.
Great, thanks, Nick. And so then the first investment theme was stable coins. And I think some of the audience may not fully understand why stablecoins are the first killer app, if you will, beyond Bitcoin. Matt, maybe you could just fill us in a little bit for why are stablecoins such a big deal, particularly in the Southern Hemisphere?
Well, it really comes down to there's this insatiable appetite for dollars across the world. And so where we're seeing probably the largest stablecoin adoption per capita is in some of the jurisdictions where they have very weak fiat currencies. And so countries in Africa, countries in Latin America, where there's rampant devaluation of the local currency. And there's almost this behavior that has emerged over the last 20, 30 years of getting paid in local currency and then buying just physical objects, buying hard assets. And this was something that Yellow Card saw, where there would be behavior around building half of your house one year just because you didn't want to store your wealth in local fiat currency and continuing to put money into it. And so now for the first time, you can actually hold $1 on a smartphone. Getting access to the US banking system is very difficult. In a lot of these countries, you wouldn't be able to get a Bank of America account, for instance, based on where you live. But now there's the ability to get paid in your local currency and to swap that almost immediately into an Ethereum wallet and hold US dollars. So we're starting to see that really turn into a flywheel effect where now remittance payments are starting to go into these corridors. Wealth is starting to become saved in dollars. So that's one killer use case. Now, where is this going over time? I think more of that for sure, but we'll also see stablecoins play a very interesting role in the institutionalization of tokenized securities. And so if you think about bringing a corporate bond on a blockchain or a REIT onto a blockchain, that's great. You have the representation of the asset, you can move that around. But if you have to settle the transaction by doing a wire and it's a T+1 settlement on the wire, that's not really that exciting. And so the ability to actually tokenize the US dollar in an institutional context could be the real catalyst for unlocking some of these tokenization use cases across a range of issues. So we really see stablecoins as playing into not just the dollarization of fiat currencies, but also the settlement infrastructure for US financial services.
Got it. Thank you. And so can you give us an example of a stablecoin sort of startup that you're backing, and why does the world need another one? I thought we had Circle and Tether and so on already.
Nick, why don't you talk about Mountain and then I'll talk about Felix Pago.
Sure, yeah. So there are two major dominant stablecoin issuers that together I think have approximately 90% market share. Tether, 70% market share, by far the world's biggest stablecoin. Circle. The reason we think that there is going to be a more heterogeneous set of stablecoin issuers is because there's not just one bank in the world. There's a bunch of different ones. They are in different geos, different regulatory regimes, and they pay variable interest rates and offer different product types. And stablecoins are like that. On the surface, it's just a tokenized dollar that exists on a blockchain, but there is a huge design space for a stablecoin. There's the regulatory model, there's the custody model, what kind of collateral and how safe it is. Are you holding overnight reverse repos to back the stablecoin? Are you holding treasury bills? Are you holding deposits in a bank? Some other kind of credit instrument? So there's variability there. There's variability in terms of how actively the stablecoin works with law enforcement. Are they actively freezing addresses? Are they decentralized? Are they unable to freeze addresses? And there's yields. So starting this year, as interest rates rose, anyone that was holding a stablecoin faced a significant opportunity cost around 500 basis points in the US versus the risk-free rate in TradFi, whereby if you're holding a stablecoin, for the most part, you weren't getting paid anything. So you were had this sort of 5% opportunity cost versus holding fiat or holding a treasury or a money market mutual fund. We realized last year that a new cohort of stablecoins would emerge that passed on most or much of the yield from the underlying credit instruments that they held in reserve to the holders of the stablecoin. We felt this would be very disruptive. The major stablecoins don't pass on that yield. Tether doesn't do it simply because they can get away with it. Frankly, they're big, liquid, global stablecoin. They actually don't need to pay the yield to persuade people to hold it. Circle's USDC, they don't pay the yield because there's regulatory prohibitions against that in the US. The US stablecoin can't pass on yield or they'd be considered a security by the SEC. So we wagered that there would be emergence of offshore dollar stablecoins that were interest bearing, that competed and took a chunk out of the market share of the big stablecoins by offering a higher yield. And this is analogous to banks competing on the basis of the interest available in a savings account, for instance. Especially you see this competition as rates rise. Some banks try and suck in deposits by hiking the yield on savings. And so we backed a stablecoin fully regulated out of Bermuda. The Bermuda government is very pro stablecoins. They're quite a sophisticated financial regulator, actually, as it turns out. And they have the second largest reinsurance market in the world. And they've been pro crypto since 2018. They created a stablecoin framework, and Mountain Protocol is the name of the company. They were the first stablecoin to be registered in Bermuda. And they took this proposal to the government of Bermuda and got approval to launch a fully interest-bearing stablecoin, whereby just by holding the stablecoin on the blockchain, you receive the yield from the underlying instruments in real time. And they grew very quickly post-launch. We led the seed. They just raised a Series A led by Multicoin. And, that's a class of startup we find to be very exciting because they're creating a consumer surplus. It's a better experience for an end user with the same risk model in our view. And they're doing very successfully. And then we think that ultimately interest-bearing stablecoins are going to take a huge chunk out of the established ones like Tether and USDC. So that's a pretty exciting sector for us.
Got it.
So
Thank you. That's a great example. And then Matt, you said you had another example.
Yeah, I think there's various ways to access this thesis if you're excited about stablecoins. Investing at the issuer level, certainly we think there's going to be some big winners there. I also think there'll be some large US companies that launch stablecoins once we have a stablecoin bill passed in the United States. So that's an interesting category. The other one Nick alluded to is really these fintech front ends that are providing payment services. And so we've recently invested in a company called Felix Pago, which is powering remittances from the US to Mexico, and really doing it in a way that completely obfuscates the fact that there's a stable coin under the hood. And so now the user experience level here is quite seamless, and the ability to get in and out of these assets. We think there's just going to be a lot of innovation at that level as well. So that's an area that we're quite excited about, and looking at different corridors right now, trying to understand what the remittance dynamics will end up being.
Got it. Thank you very much. One of the things Alison I'm now moving to another topic, but one of the things Alison had said in her opening comments was just how incredibly difficult it is to be an early stage venture capitalist, because there's so many things you've got to solve for. And one of them is access to the best entrepreneurs. And there's very few good entrepreneurs, especially in areas of new technology like blockchain. So I want to go from sort of your investment thesis and focus to how you actually execute your strategy. How do you actually get, great opportunities, great teams, and how do you work with them in that first phase of the conversation?
Yeah, I'm happy to kick off and then maybe kick it over to you, Nick. The way we think about this is if you look at the arc of venture capital since maybe the 1970s, all of the returns have really been driven by being in the top 10 companies each year that have been started. And so it's really about getting into those best names. Now, how you do that, I think, can differ by fund. Historically, we have been thesis driven around categories where we have a strong intuition that they will exist. And so the institutionalization of digital assets, for instance, we had a strong insight that companies like Fidelity would build custody services and trading technology. And we're able to invest in some of the companies that were in that slipstream, able to sell into big organizations like that. But another part of it is just really getting your brand and your reputation out there in the ecosystem. And so frankly, that was a big part of the reason why we started the podcast in the early days, is really just an excuse to be very vocal about things that we believe, talk about the regulatory landscape, also talk about some of the things that we don't believe in, or some of maybe the more nefarious corners of this industry. And really use that as a flywheel to get in front of entrepreneurs and really try to build rapport almost even before the first meeting, where our views are out there. Nick, you might add to that.
Yeah, our objective is for founders to know us and what we stand for and what we believe in as a firm before we've ever met. And of course, the podcast that we've been doing for 4.5 years now, On the Brink, is great because our views are being delivered into these founders' heads every single Friday. So that's a big part of the strategy. We do have an active content strategy. That wasn't a contrived thing. It was just a very natural function of the way we like to operate. So we do blogging. We discuss every deal really that we lead in detail. We're active in academia. We publish white papers. One of the things I'm proud of is we wrote a white paper about stablecoins back in 2020 when they were super incipient, and named them as a crypto killer app and made it clear we'd be investing in the category. And through that and other content we've created around stablecoins, we've had a lot of inbound. The other thing is, over time, as you have a number of portfolio companies, I think we have approximately 70 now, you develop a very strong founder network, and sometimes the founder references are the strongest way to get in front of an entrepreneur. So we found that to be very, very helpful. And then honestly, a lot of it is boots on the ground, going to conferences, being present at these places. That's kind of the unscalable art of venture capital, is building these relationships and being physically there and having a presence, sponsoring meetups, things like that. Obviously, most funds do that. But yeah, we try to be super active from that perspective, and then on the content front, and then yeah, the really one very powerful thing for us is the sort of broader Castle Island network, which we've built over the last 6 years, and the flywheel is definitely turning right now.
Fantastic. So one of the things we hear a lot, and it's not a positive comment, we hear a lot, in the NFT boom and bust, well, in the ICO world, most ICOs were fake and the teams never planned really to build anything. They just took the money and ran. In the NFT boom and bust, lots of the NFTs were similarly supposed to be scarce, but they weren't. And the teams took the money and vanished. Or now we're hearing it in meme coins too. Do they really plan to build anything? How do you mitigate against that? How do you make sure the teams you back are really going to build what they say they're going to build?
Yeah, for us, everything comes down to kind of 4 variables. It's people, market, product, and then valuation, and really in that order. And so we're really endeavoring to invest in founders with what we call founder market fit. And so having traveled the idea maze and really understanding this problem area, it's interesting to hear you talk about it. I totally agree on the ICO front, but I'll say there were some innovations that came out of that movement in a really interesting way. There are projects that still exist now, Ethereum being the canonical example, that raised via ICO. And so not everything was a scam, although certainly there was just a tremendous amount of unregistered securities that were offered during that time period. Really the same thing for NFTs, but on the NFT one, it doesn't take too much of a squint to see that NFTs will probably end up being the technical primitive of the next generation of ticketing apps, and we'll have royalties in the creative arts that are really tied to this content as well. So I think it's really around finding big markets and then finding the best teams operating in these markets, and with the overlay of just regulatory, which has honestly been very difficult in this industry, because on one side you can say the SEC has been overactive in certain categories, but ICOs, Matthew, is a perfect example of where the SEC should have been a lot more involved earlier in shutting down some of these fraudulent securities offerings.
Yeah, I'll just add, it's worth noting that our primary focus as a firm since the start has been operating and investing in operating businesses as opposed to tokens. So to a certain extent, we mitigate that risk just by focusing on entrepreneurs that are building businesses, which I think, tends to eliminate a little bit the risk that they're not, fully committed to the business. Yeah, and as Matt says, Ethereum was an ICO, and Binance, for their flaws, they were also an ICO. So there have been, good things that emerged from the speculative boom, and we see this in other areas where there's valuations that are out of line with fundamentals. We see this in the AI boom, which is clearly producing real value, but you also have a speculative element. Saw this in previous bubbles, like the railroad bubble, for instance, with lots of misallocated capital, but then really useful infrastructure was built. So that's kind of the way we see it, is you can't eliminate the speculative aspects of the market. You just have to focus on the real significant infrastructure that's being built.
Right. So the last question I have that I planned, and then we've got some audience Q&A coming in too. But we always say to our investors as a fund of fund that it's exceptionally hard to get into the best deals, do the due diligence, and support the teams globally. Therefore, we do it by investing in funds like yours. But I'm curious, what do you think makes blockchain more difficult or harder to invest in than other areas of technology, if in fact you think it is harder to invest in?
My answer to that would be probably a couple of things. One is just that it's so multidisciplinary. And so there's really advances happening at the computer science level, at the core kind of compute level here that you need to stay up on. The regulatory landscape is different by geography. And so just understanding the changing tides on the regulatory environment, that can be existential to a company. If you misdiagnose the regulatory strategy in an underwriting, you really can take a quick zero. So that's a challenging one. I think there's also kind of a game theory or almost a central banking element to some of these networks as well that is kind of difficult to ascertain if you're not in it every day in terms of how tokens actually work. And as Nick mentioned, we're more on the equity side, but I think that's one of the really interesting things about underwriting new protocols is just understanding what the token actually does. Why should it be valuable? Is it actually driving utility on the network? So those would be my first. I'm sure Nick has something to add.
Yeah, the number one challenge I would also echo Matt is regulatory. In the US, we have a pretty hostile regulatory environment, so there's a lot of ambiguity as to, for instance, whether a token is a security, but also much beyond that. Crypto startups have this idiosyncratic problem where banks don't want to service them, which is something we've been pretty vocal about. That's not something you see in other industries. You don't see traditional tech or software companies being excluded from the banking sector because they, are active in a specific industry vertical. So there are just fundamental challenges there that our startups have to surmount, and oftentimes there's additional costs that high fixed costs that startups have to face because they're considered money transmitters in the US. So getting that right is fundamental. And then the other thing is to be a generalist crypto investor, you have to be a specialist in many different domains. So, popular themes right now are sort of the intersection of AI and crypto. That requires some AI understanding expertise, zero knowledge proofs, especially hardware around zero knowledge. That's incredibly complex. Custody setups, things like fully homomorphic encryption. Again, you're kind of at the frontier of the field. So if you want to invest generally across the crypto space, it does require an understanding of these relatively niche academic fields. So that'd probably be the other challenge that I would call out.
Great. So thank you. Even being able to name them all, we can tell you have a lot of expertise.